Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of Naidrich Securities. And I'm pleased to be joined by my partner, CFA, all things liquidity, Fed, and everything else that's important here with rates, Gregory Faranello. Okay, Greg, great to see you. And we are very pleased to have Priya again from TD Securities. Priya, thank you so much for joining us.
Thanks for having me.
So I feel like I've been saying this a lot lately. Every time there's a Fed meeting coming up, that this is the most interesting one and there's a lot on the line, but I actually really feel that way this time. I think a few months back it was 50 and now everyone's kind of thinking about 75, and there's others who may even think higher than that. So what I think is one of my strong points about these meetings is I always let the smarter people get after it and step out of the way and join at the end. So Gregory and Priya, again, thank you both, and we'll enjoy the conversation.
Michael, thank you very much. Great to be back. 3.5 years running. Priya, it's fantastic to have you back. I looked at my notes. The last time we were together, the world was a lot different in December of 2021. And to Michael's point, it is a big meeting, and there's been a lot of debate, 50, 75, even a little bit of 100 basis points. I'd love to get your thoughts, December through now, heading into the meeting, what you think about this meeting, and some comments maybe on the presser, the statement, and the dot plot.
Sure. Thanks for having me. As you said, it's been a year. It's been quite the year. I think the Fed has been nimble and humble. I think markets and analysts have as well. So I think we've all changed our estimate for the terminal rate, or how quickly the Fed gets there, what's after that. We've all gone through many iterations of this. But as we stand now, and I will say what changed in the last few weeks, I mean, there's a Fed commitment to inflation, which I think has come out more strongly after Jackson Hole. I think this is a different Fed from a year ago that said, well, not just is it transitory, but we'll actually tolerate an overshoot. In fact, the FAIT policy or inflation targeting was actually looking for an overshoot, to a Fed now that's signaling a single mandate. It's a single mandate central bank, I would argue, right now. And that could change if inflation gets closer to target. I think they start to look at the economy, the growth side. But right now, it's all about inflation. So that's a very clear communication from the Fed in the last month, I would say. And then it's the data front. I mean, I think there's some signs of slowing. We're particularly looking at some of the high frequency measures of slowing, but it's still a very strong labor market. And on inflation, that's where the surprise came in last week, with a stronger than expected core inflation number. And it wasn't driven by some one-off indicator. It was unfortunately the most sticky component of inflation, rent inflation. And so, if core inflation hasn't even peaked, or it's not clear that it's peaked, and even if it is peaked, it's just too high. So that's why we're actually looking for 75. We changed our call. We were in the 50 camp. Last week after CPI changed our call, so we're looking for 75. I know you can extend it to maybe say, why not 100? But the Fed has raised a lot. I mean, if we were starting at 0, I think 100 was quite the possibility. We're at 2.5, which is the Fed's estimate of long-term neutral. So, well, they've already done some work. I think going 75 is still, that's a lot of basis points of hikes. The market's priced for it as well. We're pricing in it like 15% chance of 100. I think you can never discount 100, just as you can't discount a 50. But I think a 50 is going to be tough for them to justify, because inflation's still a problem and the economy has not really slowed all that much, particularly the labor market. So we're looking for 75. I think beyond that, it's going to be all about the dots and the SEP, because we're going to get another year, so we get the 25 dots. Now, in a nimble central bank world, how much faith should we have on those dots? But we don't have too much forward guidance. So I think we'll be looking for, where's the end point? Where do they stop? How long do they keep it there? I think that's the one the market's struggling with, because we're pricing in cuts as early as September next year. Or at one point, we were pricing in cuts in June. Now the cuts have been pushed out a little bit. So when do they start to cut? How much do they cut? I think these are all questions we'll be watching. I don't think we get a whole lot from the press conference, because it's going to depend on the data. And I think Chepal is going to leave a lot of options still on the table. So plenty to digest on Wednesday. But I think the market is priced pretty accurately here or you can almost argue that the market's pricing in a hawkish Fed, which we expect we get. But that's why I think most of the market reaction might be before the meeting than really on meeting day.
Interesting. Thank you for that. And it is, Michael and I kicked this around 50, 75. Michael was in the 75 camp. I was more along the lines of hoping they would notch down to 50 because the data is changing, as we know. But the dialogue about 100 has been real. And so we wake up this morning and 10-year yields are at 350. These are the highest levels that we've seen since 2011. Obviously, real yields have moved out, quite a bit too. And we're looking at curve shape. And I know you've spoken a lot about, twos, tens and your views on inversion. I'd love to get your thoughts on the long end of the curve here, tens in and around 350, where you see that potentially going, and thoughts relative to that with regard to yield curve shape.
Sure. So I'm glad you bring up the real component of the rate increase, because that's the one I focus in the most or zero into. If interest rates rise, but it's because it's inflation led and real rate led, I think it's more sustainable. When it's all a real rate driven increase, that is what is damaging to financial conditions and the economy. And so actually our call is that the 10-year peaks around here. We actually have it staying not much lower than here for the next few months, and then actually declining a lot next year. That's when I think once the hiking cycle is behind us, which we think they end the hiking cycle either end of this year or early next year, and then they keep rates there and sort of wait for the lagged effect of monetary policy on the economy. As the economy slows, I do think rates fall, but led by the long end. So it's kind of linked. Your two questions on rates and the curve, I think, are linked. We see the flattening of the curve continuing, and actually more than just how flat does the curve get? We're thinking two stands at -60, it could be -70, 80. I don't think you get as high or as inverted as in the 1980s, just because the level of interest rates are lower. But it can just stay there for a really long time, because
Right.
for the first time, you have a Fed that's saying that they will tolerate quote unquote pain. And so I think I'll be watching in the SEP how they define pain. Is it a 5%? In fact, the more the unemployment rate increases in their forecasts, the more inverted that curve will get. So I think the 10 years largely done. It could stay around here. I am watching global rates. I think one of the reasons why we've sold off beyond Fed hikes and QT is the movement in global rates, but global growth is clearly slowing. So our thought process is that global interest rates in the long end have largely peaked. But that inversion is going to keep in. I think the curve keeps inverting and stays inverted for longer.
Yeah, interesting. I wrote this morning to our clients, about this inversion. But to your point, and I agree, if you look back in history, curves can stay inverted for quite some time in reality. And so the higher for longer seems to be a clear narrative for the Fed. And we've been living in a world of lower for longer now for so long. So in conjunction with that, as we talk about the market repricing, the economy, we've got this balance sheet in the backdrop. We know, I think Chair Yellen at one point said we wanted to run like paint drying in the backdrop. And I know this Fed chair and committee has said the same thing. Can you give our clients an update on balance sheet, where you see it at? I know we're ramping up a little bit as we head into September in terms of the caps. What are your thoughts there?
Yeah, I actually think it's a very powerful source of tightening financial conditions, moving those real rates higher, which hurts financial conditions as well as the real economy. I know the Fed doesn't talk much about QT because they view it as a passive policy. It's been set in stone. As you said, it ramps up in September. There's no further ramp up. We don't think if inflation stays high for longer or rises from here, that the Fed makes any adjustments to QT. It's just going to continue to run off until we see signs of reserve scarcity. We don't think we're there yet. If that's the only thing the Fed looks at, I think it's early 25, or that they cut rates. So actually our thought process is we do have the Fed cutting rates next year. I know we didn't talk about next year, but by the end of next year, we have the Fed starting to cut rates and they'll stop QT. But for now, QT continues. And what that does is beyond letting reserves drain, which I think banks have enough reserves. So I don't, we're going from high excess reserves to just excess reserves, but it adds duration pressure. It affects that belly of the curve because we need to find private buyers to buy treasuries and mortgages. And this is at a time when foreign reserves are slowing, mutual funds are seeing outflows, banks are seeing deposit outflows, so they're not buying. So it adds to the supply demand dynamic, which is one of the reasons why rates have risen, I think, is QT. The fact that it's driven by real rates, it's that term premium coming back into the treasury market. But we think that they'll stop QT once they start to cut rates. So it's going to become a really macro decision on QT. But for now, yes, it is more supply that the fixed income markets have to handle.
So I'm going to stay on that topic of cutting rates in 2023, which I think is great. And if I'm reading you correctly, you think this terminal rate, obviously we're front loading here, we can go up really quick. So get to 4, maybe a little above 4 quickly. And then over time, be led by the long end, coming down to signal that the Fed is going to cut in 2023. So relative to that, what's your thought on the economy heading into 2023? We're seeing obviously slowing in some of the interest rate sectors, inflation, that trade-off, and then most importantly, I guess, employment as we head into 2023 relative to the inflationary picture.
Right. So I think relative to the market, I'll tell you where we're slightly out of consensus. I really struggled with the soft landing narrative. I think 6 months ago, we were actually in the soft landing camp, thinking the Fed raises rates to slightly above restrictive, and then they give it time and we get a soft landing. Now, if they're front loading, and we're talking our terminal rate forecast is 4.5, they get to 4.5, they keep it there, as you said, higher for longer. The impact on the economy is unquestionable. It's going to slow things down. And, you talk about the labor market, it's extremely strong right now. It's tight. I think companies have struggled to hire and retain workers. So we actually think they'll be a little late to let them go. And so when the rise in the unemployment rate starts, and maybe it's a little later than it would be given the economic backdrop, it rises much faster. So I struggle with the Fed's 4.1 on the unemployment rate. That was in the last set of SEP. I think they're going to move it up, but our thought process is a 5% is more likely by the end of next year on the unemployment rate. And that's when the pressure on the Fed will build from the growth side. And if inflation has come down, now we don't think we're at 2%, but if inflation's around 3 and the unemployment rate is at 5, that single mandate central bank goes back to looking at the growth side. That's when we have cuts. Now, the market is pricing in the start of cuts, but where I struggle with is we're only pricing in 75 basis points of cuts. Well, that still leaves rates restrictive. I think when they start to cut at the end of next year, they're cutting all the way to 2.5, maybe 2, maybe 1. I think 0 is a little tricky. We're going to need a really sharp recession. But a shallow recession would be consistent with 150 or 200 basis points of cuts. And that's what we're looking for, not so much in 23, end of 23, but really it's a 24 story when the cuts come in.
It's interesting. I had a conversation with a few clients this week at dinner, and they were echoing that sentiment exactly, that they think we're going to go up hard, but ultimately when they come down, they're not going to come down 50 or 75. They could very well come down a lot when that trajectory really changes. So this has been wildly helpful, Priya. We love having you, and I really appreciate you coming back for a second time. I think we covered a lot. There's a lot more to talk about, obviously. I mean, these issues are really, really complex. But right now, if you don't mind, I'm going to turn it back to our co-CEO, Michael Naidrich.
Yeah,
Michael?
Thanks, Greg, and thanks, Priya, so much. Just a really fascinating 15 minutes here listening to you two both speak. And I agree with you, Greg. It's just such a complex time, and it's so important to kind of be thoughtful about all the alternatives and what it can mean, short, medium, and long term. It has some real consequences all the way around. So, Priya, again, grateful having you here for a second time. We look forward to having you a third time, hopefully. Greg, 3 years later, you know how I feel about this. This is my most fun I have all week, certainly all quarter and monthly. So it's all good. And to any of our clients that would like to speak to Greg, obviously he is always available just to reach out to your representative. So I wish everyone a great start to fall, and we look forward to seeing you all next month. Thank you all.